Ladies and gentlemen, welcome to Asian Guy Analysis on 18th of January 2026. Silver prices moved faster than most investors expected. In a short time, silver climbed close to $90 an ounce. Now, one question matters. Is silver moving toward $100, or is this rally losing strength? In this video, we look only at the charts and real market signals. No predictions, no noise, just what the data is showing right now. When we look at silver's long-term chart, the first thing that stands out is how unusual the recent move has been. For several years, silver traded in a wide but controlled range. Prices struggled to hold above major resistance levels, and every rally attempt eventually faded. That changed in late 2025. Silver didn't just rise, it broke through multiple technical barriers that had capped prices for a long time. These breakout levels matter because they reflect investor behavior, not headlines. Resistance forms where sellers consistently step in. Like when price pushes through those areas and holds, it suggests that selling pressure has weakened and new buyers are willing to pay higher prices. After the breakout, silver did not immediately reverse. Instead, it consolidated briefly and then continued higher. This is important. Sharp breakouts that hold tend to attract larger market participants who wait for confirmation rather than chasing early moves. Momentum indicators on the chart also confirm the strength of the trend. Silver entered overbought territory, but instead of collapsing, price stayed elevated. This tells us the move was driven by sustained demand, not a short-term spike. Another key detail is volume. During the breakout phases, trading activity increased noticeably. Rising prices combined with rising volume often signal genuine participation rather than thin market moves. On a weekly time frame, silver is now trading well above its long-term moving averages. This reflects a structural shift in the trend. Markets do not stay far above these levels forever, but when they do, it usually signals strong underlying momentum. At the same time, the chart also shows that the rally has been fast. Steep price moves compress time and increase risk. Historically, silver is known for sharp advances, followed by periods of cooling or consolidation. That does not mean the trend is over. It means the market is no longer in a quiet accumulation phase. It has entered an active phase where price reacts quickly to new information. Right now, the chart is sending two messages at once. First, silver has clearly broken out of its long-term range. Second, the speed of the move means volatility should be expected. Understanding this balance is critical. The chart does not guarantee higher prices, but it confirms that silver is no longer trading like it did in previous years. This shift in behavior is the foundation for every discussion about what comes next. To understand why silver is moving this fast, we need to look beyond the chart and into what is driving real demand and real behavior in the market. One of the biggest forces behind the rally is industrial demand. Silver is not just a store of value. It is a critical industrial metal used in solar panels, electric vehicles, electronics, and advanced manufacturing. As clean energy production expands, silver usage increases alongside it. Solar technology alone consumes a meaningful share of global silver supply, and demand in that sector has continued to grow. This demand is structural, not speculative. Companies that rely on silver cannot easily substitute it without redesigning entire production processes. That makes demand less sensitive to short-term price changes. When prices rise, usage does not immediately fall. At the same time, silver supply has remained constrained. Mining output has not increased at the same pace as demand. New silver projects take many years to move from discovery to production. Permits, infrastructure, and financing all slow the process. As a result, the supply side of the market reacts slowly, even when prices rise sharply. This creates a mismatch. Demand adjusts faster than supply, and prices fill the gap. Investment behavior has added another layer to this move. As silver prices broke above long-term resistance levels, interest from funds and institutions increased. Silver ETFs and futures markets saw stronger participation as investors looked for exposure to both precious metals and industrial materials. These flows matter because silver is a relatively small market compared to assets like gold or oil. When large investors move in or out, prices can react quickly. This is especially true when physical supply is already tight. Another factor is how silver fits into broader macro conditions. Inflation concerns, currency uncertainty, and shifting expectations around interest rates have kept investors focused on hard assets. While gold often gets the spotlight, silver tends to move later and faster once momentum builds. That pattern has shown up again in this cycle. There is also an important psychological component. Once silver began outperforming gold, attention increased. The gold to silver ratio compressed, signaling that silver was leading rather than lagging. This shift drew in traders who watch relative performance rather than absolute price levels. However, it is important to separate causes from accelerators. Industrial demand and supply constraints created the foundation. Investment flows and momentum accelerated the move. This distinction matters because accelerators can reverse quickly, while structural drivers change slowly. If investment demand cools, price volatility can increase even if long-term demand remains strong. The rally, therefore, is not driven by a single headline or event. It is the result of several forces aligning at the same time. Strong industrial usage, limited supply growth, and renewed investor interest all contributed to the price action we see today. Understanding these drivers helps explain why silver moves so quickly and why the market remains sensitive to new data. This context sets the stage for the next question. What signals are emerging now that prices are elevated, and what do they tell us about market conditions going forward? One of the more important signals appearing in the silver market right now is backwardation. Backwardation occurs when the current spot price of silver is higher than prices for future delivery. In simple terms, buyers are willing to pay more to get silver today rather than wait. This is not common in precious metals and usually signals tight physical conditions in the market. When backwardation appears, it often reflects immediate demand pressure. Manufacturers, traders, or institutions may need silver now and are willing to pay a premium for it. This suggests that available supply in the near term is limited. On the chart, backwardation shows up as a sign of stress in the supply chain rather than speculation alone. It tells us that demand is not only financial, but also physical. Historically, backwardation in silver has appeared during periods of strong rallies. It often coincides with moments when inventories are drawn down and delivery becomes more valuable than contracts for later dates. However, backwardation should be interpreted carefully. It does not automatically mean prices will continue higher. In past cycles, it has appeared both during sustained uptrends and near periods when the market began to cool. That is why this signal is best viewed as a condition, not a prediction. In the current context, backwardation supports the idea that the silver market is tight. Combined with strong industrial demand and limited supply growth, it reinforces the case that this rally is rooted in real usage, not just trading activity. At the same time, backwardation can increase volatility. When markets price scarcity, small changes in demand or supply expectations can lead to sharp price moves in either direction. Another important point is duration. Short-term backwardation can resolve quickly if supply loosens or demand slows. Persistent backwardation, on the other hand, suggests deeper structural stress. Right now, the signal appears intermittent rather than constant. That means the market is tight, but not completely dislocated. For investors and observers, the key is not to treat backwardation as a green light or a warning sign on its own. It is one piece of a larger picture. When combined with price trends, volume, and positioning data, it helps explain why silver is behaving the way it is. In this cycle, backwardation confirms that silver is not moving purely on sentiment. Physical demand is part of the story. But as with all tight markets, conditions can change quickly, and that is why ongoing monitoring matters. Understanding this signal helps set realistic expectations about risk and volatility as silver trades at elevated levels. To understand how this rally may develop, it helps to look at who is actually participating in the silver market right now. Different groups behave very differently during fast price moves, and the current rally reflects that split. Retail investors, which include individual buyers of physical silver and small trading accounts, have shown mixed behavior. After the sharp rise in prices, many retail participants began taking profits. This is a common response when an asset moves quickly and headlines become widespread. Retail investors often react to price, not structure. When silver was quiet, interest was low. As prices surged, attention increased. Now, with silver trading near elevated levels, caution has returned for many smaller participants. At the same time, institutional investors are behaving differently. Larger funds, asset managers, and overseas buyers have increased exposure during and after key breakouts. These participants tend to focus less on short-term swings and more on long-term trends, supply dynamics, and relative value. Institutional participation matters because these players move more capital and typically enter positions over time rather than all at once. Their activity often supports price stability during pullbacks, even if volatility increases. Futures market data also reflects this divide. Commercial users and managed money accounts have adjusted positions, but not in a way that suggests a full exit. Instead, positioning shows active participation rather than exhaustion. Another group to consider is industrial users. Companies that rely on silver for production are not speculating. They buy based on operational needs. When prices rise quickly, they may hedge or secure supply, which can add pressure to near-term demand. This behavior does not show up as enthusiasm or fear. It shows up as consistent buying during periods of tight supply. The contrast between retail caution and institutional participation creates a specific market dynamic. Retail selling can add short-term pressure, while larger buyers absorb supply over time. This does not eliminate volatility. Silver is historically volatile, especially after fast rallies, but it does affect how pullbacks behave. Markets driven purely by retail enthusiasm tend to collapse quickly when sentiment shifts. Markets supported by institutional demand often move in waves, with periods of consolidation rather than sudden breakdowns. Right now, the data suggests silver is being supported more by larger participants than by retail momentum. That does not guarantee higher prices, but it does explain why the market has remained resilient despite sharp moves. Understanding who is driving the rally helps explain why silver is acting the way it is and why price reactions may differ from past cycles. The idea of silver reaching $100 has become a central talking point, but it is important to approach this level carefully. Round numbers matter in financial markets. They attract attention, influence behavior, and often become areas where volatility increases. The $100 level is not important because of a technical indicator. It is important because of psychology. When prices approach major round numbers, traders tend to reassess risk. Some lock in profits, others wait for confirmation. This often leads to slower movement, wider price swings, or temporary pullbacks. On the chart, silver is now trading in a zone that historically has produced sharp reactions. The speed of the rally compressed time, pushing price far above long-term averages in a relatively short period. In past silver cycles, similar moves were often followed by consolidation phases. Sometimes prices moved sideways, other times they pulled back before resuming a trend. That history does not repeat exactly, but it provides useful context. There are scenarios where silver could test higher levels if demand remains strong and supply stays tight. Continued industrial usage, stable investment flows, and supportive macro conditions could keep upward pressure on prices. There are also scenarios where the market cools without collapsing. This can happen if prices pause while fundamentals catch up. Sideways movement can relieve over extended conditions without dramatic declines. At the same time, there are risks. Rallies that move this fast tend to attract short-term traders. If momentum fades or external conditions shift, volatility can increase quickly. Silver is known for sharp corrections. Even within long-term uptrends, pullbacks can be deep and sudden. This is part of the metal's historical behavior. The chart does not promise $100. It shows a market that is stretched and sensitive. That sensitivity means reactions to data, policy changes, or shifts in demand can be amplified. This is why focusing on structure matters more than focusing on targets. Instead of asking whether silver will reach $100, a better question is how the market behaves as it approaches key levels. Does it hold support? Does volume stay balanced? Does participation remain broad? Those answers shape the path forward. The $100 level is a reference point, not a guarantee. The chart is signaling opportunity and risk at the same time. As silver trades at elevated levels, the focus shifts from what already happened to what comes next. At this stage, the market becomes more sensitive to incoming data and behavior. One of the first things to watch is price support. After a strong rally, markets often test previous breakout zones. These levels act as reference points where buyers may step in again. If silver holds above these areas during pullbacks, it suggests the trend remains intact. If those levels fail, volatility can increase. Another key factor is industrial demand data. Silver's role in solar energy, electronics, and manufacturing makes demand trends especially important. Reports showing continued growth in these sectors support the case for sustained usage. Any signs of slowing demand can quickly affect sentiment. ETF flows also deserve close attention. Increases in inflows suggest continued investor interest, while outflows may indicate profit-taking or shifting expectations. Because silver is a smaller market, changes in ETF positioning can influence price action more quickly than in larger assets. Futures market positioning is another signal. Large shifts in speculative positions often appear before major moves. Stable positioning during pullbacks suggests confidence, while sharp reductions can signal caution. Macroeconomic conditions also play a role. Interest rate expectations, currency movements, and inflation trends influence how investors view hard assets. Silver reacts to these factors, but often with more volatility than gold. Another important element is how the market reacts to news. Strong trends tend to absorb negative headlines with limited damage. If silver begins reacting sharply to minor news, it can indicate growing sensitivity. Volume patterns matter as well. Healthy pullbacks often occur on lighter volume, while trend reversals are usually accompanied by heavy activity. Watching how volume behaves during price declines can provide useful clues. Finally, time itself is a factor. Markets that move too far too fast often need time to reset. That reset does not have to mean lower prices. It can take the form of consolidation and range building. At this stage, silver is no longer a quiet market. It requires active monitoring rather than passive assumptions. The goal is not to predict exact price levels. The goal is to observe how the market responds to pressure, support, and new information. The charts are still speaking. They are just speaking more quickly now. Understanding these signals helps investors stay grounded as silver continues to attract attention. Silver's rally is real. The demand behind it is real. But so are the risks that come with fast price moves. Right now, the charts are not giving predictions. They are giving signals. And those signals deserve attention.